Okay. Okay, everyone, we are going to get started. I know there's still people logging in, but hopefully they'll jump in while I'm doing my intro and won't miss anything. So my name is Erica Morin, and I'm the Manager of Training and Member Services at MSIC. Our program today, which will address current issues in accounting and financial reporting, is at the request of many of our member credit unions. And so we are really thankful to Marcum for putting together what is going to be an information-packed session. Today from Marcum, I would like to welcome David St. Ives, who is a partner in Marcum's financial services practice and national industry leader, Brenda DaCosta, a partner in the firm's financial services and not-for-profit practices, and Mark Giampaolo, who is a director and the New England co-leader for Financial Institutions Services Group. Thank you each for being here. We really are going to look forward to the presentation. Just a note to our attendees, at the conclusion of today's presentation, we will have time for questions and answers, so feel free to send your questions via the Q&A or the chat box at any time. They're found at the lower right-hand corner of your screen. You can send them anytime during the presentation, and we will circle back to them at the conclusion. With that, I'm going to ask Mark and Brenda and Dave to take it away.
All right, thank you, Erica, and thank you all for having us here today. It's truly a pleasure for us to be here. As Erica indicated, this session will cover a variety of different topics and hot topics in the industry. And we do have a lot of items on the agenda. So, with that, we'll dig right in. I think the first piece that we really want to talk about is the CARES Act and loan modifications and, the overall impact to the industry. And, as you all know, this has just been one crazy year, right? Between branch closures, juggling staff limits, you've just faced so many challenges. Then the loan modification started. A lot of decisions needed to be made and made pretty quickly. And the guidance and clarification of guidance kept coming in as these decisions were being made. And sometimes that clarification changed what was previously thought to be a proper interpretation. So, the overall impact of that has continued to change and, really broaden the landscape on the overall impact of the portfolio and operations. Now, a lot of this might seem kind of like old news, but I think it's important that in order to kind of talk about where we are and how we got here and where we're going to go is to really talk about, what led to this point. So, it does bear a lot of relevancy still. So before COVID hit, there was this big, trouble debt restructurings was always a huge consideration in modifications in the overall loan portfolio. And, as we all know, the golden rule was really, if you granted a concession to a borrower that was experiencing financial difficulty and that the institution ordinarily would not consider to grant to, a borrower under ordinary terms, that chances are that was a trouble debt restructuring. And again, as we all know, once a TDR, always a TDR, evaluate for impairment in the allowance for loan loss, separate disclosures, things of that nature. So that was really the old school and the tried and true, and that guidance still does remain. However, with COVID and specifically the CARES Act, there came this additional guidance that came out, and it was from the CARES Act was what's known as Section 4013. So in response to that 4013, the regulators then came out in April of 2020 to offer some additional guidance. And this additional guidance really revolved around, the evaluation of a loan and the ability to carve it out of that TDR status. really talked about non-accrual status, payment deferrals, things of that nature. And then later on in August of 2020, there was additional guidance that came out, and that had to do with additional loan modifications. Now, clearly there was a lot more guidance that came out other than what we have listed here. But you know, just for the time allotment and for all intents and purposes, we really just are focusing on the probably most significant guidance that that came out. So under the interagency guidance, there were a few differences between CARES and interagency. So under the interagency guidance, in order to be able to carve a loan out of TDR status, the borrower needed to be current, which is defined as less than 30 days past due when the modification program was implemented. And the duration of the deferral needed to be a short-term duration, and this was specifically defined as being less than 6 months in duration. And, you know, there were various modifications that were allowable. And as is always the case, management, you know, really should be needed to use judgment as to whether or not the modification was related to COVID-19. There was also, with that interagency guidance, really extensive Q&A and scenario guidance that was provided with that, which, you know, I think was somewhat helpful with various examples and, you know, how do we treat this under these certain circumstances. Under Section 4013 of the CARES Act, again, borrower needed to be current, which was defined as not more than 30 days past due when the modification program was implemented, or as of 12/31/19. It needed to mark, next slide, please. Thank you. As of December 31st, 2019. The modification terms under the CARES Act were different. It did not define a 6-month period for deferral. So under 4013, you weren't tied to that 6-month period. It also allowed for interest rate modifications, with which regulatory guidance did not allow for. The period was to go between March 1st, so it was modifications between March 1st and the earlier of the end of the national emergency in January 1st of 2022. That has later been extended, though, as we all know, through the Consolidated Appropriations Act as we continue to kind of work through all of this. So that being said, what was the overall impact on the loan portfolio and various considerations that you need to be thinking of as these loans continue to, you know, kind of work out and you evaluate them on a go-forward basis? So as a lot of these loans, the deferral periods neared the end, I think that, you know, for the most part, what we've heard is that there wasn't that second wave of modifications and deferrals, that it wasn't as great as it was originally anticipated to be. Some of that could have been because of that stimulus money that came out and, you know, various other assistance, but it was found that it really didn't end up having as huge of a wave of second deferrals as was anticipated. But still, the evaluation needed to be made. You know, once this accommodation is over, is the borrower reasonably able to resume the payments, or do they need another arrangement? And does this new arrangement now put this loan under TDR status? If a loan was previously treated as interagency, and now will be, you know, say past that 6-month deferral period, can you now go back and carve it into a Section 4013 so that it still was not qualified as a TDR? You know, each loan really needed to be assessed, and each borrower needs to be assessed with the facts and circumstances, because each had its own story and its own, you know, credit quality issues and things of that to come down to consider. But, you know, again, it's always that facts and circumstances. I think in the beginning, one of the misconceptions with the loan deferrals, you know, really had to do with risk rating of the loans. And I think early on, there was a thought that there really didn't need to be much factor given to the risk ratings on the loans. And the regulators were very, very quick to come out and say, although a loan deferral does not automatically trigger a risk rating adjustment, there really needs to be an evaluation of that. You know, if this borrower is coming back and is having trouble resuming payments or is asking for a subsequent modifications, that really could be evidence that there might be some underlying deterioration in that credit quality, and that there is maybe higher risk on that loan, that it does warrant some sort of a, you know, risk rating adjustment. It all really came down to monitoring these loans. And, you know, all the institutions have a pretty strong monitoring system in place already. You've got your watch list, you've got, you know, your non-accrual lists and everything else that are being presented and evaluated on a you know, highly routine basis. So I don't think that any of this was, you know, really new news to anybody, but just really more of a focus on this kind of segment of the portfolio that has some different aspects to it than what you may have already or normally had in the past because of these deferrals and the modifications and just the overall economy and the, you know, the impact on the borrowers in general. There's been a lot of impact on the overall allowance for loan loss calculations that we've seen. You know, clearly we've seen an increase in the Q factors. There's still a lot of uncertainty out there. You know, just as we continue to open up and, you know, what's the impact going to be on these various industries. And, you know, for that reason, it still warrants that increase in the overall Q factors. There's still a lot of, you know, particularly in the commercial real estate industry, there's still, you know, a lot of uncertainty with respect to, you know, has the eviction moratorium, has that masked some potential, you know, impact on losses that's out there. And, you know, with this new work from home model that a lot of people have adopted and looks like it's going to be here for a period of time to stay, you know, is there some impact of tenants giving back space? How will that impact, you know, the overall value of these commercial spaces and even leasing arrangements and things of that nature? You know, there remains a lot of uncertainty going forward. But again, every arrangement has its own story. And, you know, you really, as you always do, it's not just the loan itself, but it's also, you know, what's the guarantor? What are the pockets behind that loan? And, you know, what's the overall impact on the portfolio itself? I think also coming out of CARES, which really isn't related to the allowance portfolio itself, but one of the other most significant factors that we're talking about and seeing and hearing a lot of discussion about is just liquidity and, you know, dealing with that. And what do you do with it? Institutions are just flush with cash right now. And, you know, I think one of the major concerns that we are hearing about is not so much handling that loan portfolio, but rather, you know, what do we do with this cash that we have on hand and how are we going to deploy it? We know that consumers are going to start spending, but we just don't know at what rate they're going to start pulling that money, you know, out of the institution. Do you have contingencies in place in case the cash outflow is larger and quicker than, you know, your crystal ball may anticipate it to be? And then, you know, on the flip side, do you managing the balance sheet on a long-term basis? Do you go long on the investments and, you know, kind of tie up assets to get that greater rate of return than you're getting, you know, from maybe some of these short-term investments that you have? So it's, you know, in that case, you're tying up the assets. So do you have those contingencies in place? There's a lot of questions that remain with that. And I know that that is definitely a challenge that a lot of the institutions continue to face. So I think moving on from the allowance, this piece of the allowance, I should say, or the impact from CARES is CECL. So everyone's favorite topic. You know, as we know, CECL the can has been kicked on that a few times for the implementation date. And, you know, I guess, you know, step back, what does it all mean? I think everybody knows that the CECL stands for the current expected credit loss model. So, and really what that is a shift from calculating the allowance for loan loss based upon incurred historical losses to more of a model that has kind of a forecast aspect to it as well. We do anticipate that it will likely result in an increase in the overall allowance calculation, and the day one implementation does have an impact on equity. The initial adjustment post to equity. So the implementation date on this has been kicked a couple of times, but has landed, and it is for SEC large filers. It was fiscal years beginning after December 15th, 2019. For all others, it's 2022. So our fiscal years beginning after December 15th, 2022. So that would be, January 1st, 2023. I think it is important to note that although implementation is 2023, there is that day one adjustment. So essentially the calculation would need to be done for 2022. So you would know what that day one adjustment is for that new calendar year of implementation period. There is a final rule that was issued by NCUA that's kind of hot off the press. It becomes effective in about a week and a half. Can't believe it's already almost August. Federally insured credit unions with less than 10 million or billion, Mark, or excuse me, million in assets, no longer required to determine their allowance using GAAP or CECL. They would be able to use, any reasonable methodology. But I think, that being said, that sounds all great, I guess, because I think everybody would love to be able to avoid CECL if at all possible. That could potentially bear impact on an audit report, because if your audited statements should be in conformity with GAAP, and if you're not using CECL when CECL is effective, then that is a significant kind of departure from GAAP. So that is kind of something to think about with that. And the other major provision of that the NCUA final rule has to do with the impact on regulatory capital and allows for a 3-year phase-in of that impact. Next, thank you. There are various valuation methodologies that come into play with CECL, and some of them are more complex than others. You are allowed to kind of mix and match within the portfolio of the valuation methodologies that you use. However, whatever you choose for a specific segment, you need to maintain that consistent methodology. So, you could use, say vintage for your residential portfolio. You could use discounted cash flows for your commercial portfolio, but you're not going to be using vintage and discounted for one particular portfolio. The Federal Reserve did recently come out with an allowance loss estimator. They call it their scaled model. NCUA hasn't commented on this yet as to whether or not it will be applicable also to the credit unions. I did sit in on a presentation the other day, and the model is really fairly interesting. It's spreadsheet based, and what it's doing is pulling information from essentially call reports of peer data. So where, the allowance for loan losses as you calculate it today is based upon your institution alone. This scaled model allows for information to come in from the industry, and that factors into the overall calculation. And it is, a pre-populated spreadsheet from the perspective of, very formula driven and things of that nature. So I think that'll be interesting. There might be more to come on that. We're keeping the lookout on that. And as far as community banks are concerned, it is specific to banks with less than $1 billion in assets. So, that being said, without that scaled as an option, the impact on the credit unions, as with any other institution, is just evaluating. The biggest question is, are we going to calculate this internally, or are we going to outsource the calculation and the model So far, we've seen a lot of our clients kind of migrate towards that external model and, a third party doing the calculation of the allowance. I don't think we've seen very many internally developed CECL models, but it still is fairly early in the process. So, and can you, next slide, thank you. As I say, it's early in the process. A lot of the institutions are in the data gathering stage right now. And again, depending upon the model that you choose is going to impact the information that you need. Some are more complex than others, but there are definite typical information that you would want to make sure you're pulling by segment, and really ordinary factors. You've got your origination dates, maturity dates, charge-offs. Historical charge-offs is the huge factor by segment. Anything related to TDRs, all of this goes into that kind of building what's the expected performance of this segment of the portfolio based upon the economic condition data and types of loans within that segment. There are three major elements of CECL. The first two of them are consistent with what you have today. You have the historical loss rate, and then you have your current economic condition factors, or your Q factors. So those are the same. The third piece is kind of what we call that crystal ball, right? It's that reasonable forecasted economic conditions. So this is the factor that, based upon all of this information that you've gathered about historical performance of this segment of the portfolio and how it reacted to various trends in the economy and the industry, what do we expect is going to be the impact on this loan that we originated today? So that's that reasonable forecasted economic condition factor. That's that third and new factor that is coming into play in your overall CECL calculation.
Brenda, just one point. Yeah. With the forecasted economic conditions, that may be a factor that credit union has to look outside of their organization as well to obtain different studies or information on predictions and economic considerations. As those factors go up and down, certainly, as we faced recently with COVID and starting to come back out of COVID, will economic conditions kick back upward? Will they go downward? So taking those into consideration, and not that you have an economist on staff or anything specifically, so you may need to look outside of the organization to get some data on that.
And depending upon where you are in the process, these are just kind of the general steps to adoption, forming a committee. I'm sure that, most organizations are actively discussing CECL, what their options are, what might be the valuation model that you're going to use. Will you develop it internally? Will you go outside and have a third party, provider assist with that? We are starting to see some institutions are kind of running parallel calculations right now. So, a trial run, if you will. And then, the consideration does need to be made for updating policies and procedures, internal controls over the calculation of the allowance for loan loss, where that will be changing. I'm sure that there will be, modifications to how it's done and who does what. And then again, required disclosures. We anticipate there will be some, changes to disclosures going forward with the financial statements after adoption of CECL. Here we've listed some tools that are helpful, various FASB guidance and different interagency guides to go to for additional resource. I'm sure you're all talking to your auditors about this, and it just continues to be a considerable effort, and will continue to be as we move towards implementation. So I am sure there will be a lot more discussion on this as it becomes even closer to that implementation date.
That moves us.
I think, the only comment I'd like to add is, CECL, as Brenda, you mentioned at the very beginning, the can has been kicked on this numerous times, but I think in listening to things that are going on within the FASB and discussions, I think it's likely than not at this stage of the game that there will be any further delays of this implementation. So, I know a lot of institutions and our clients have said, well, it's probably going to get moved again. It's probably going to get moved again. Maybe it'll go away entirely. I don't think so. I think, I think this is real, and the implementation date of January 1st of 2023 is for real now.
No, thanks, David. Definitely would agree with all of that. If there's any questions, we definitely have the Q&A session as well at the end here. That moves into mergers and acquisitions and valuation accounting. Overall in industry, there's been a significant trend within credit union consolidation, with almost 1,000 credit unions over a 6-year span here that have gone through some form of merger or consolidation, or no longer in existence. Most of these were through mergers. Obviously, there are some each year that do go through defaulting process and takeover, but overall, the trend continues. There's about 73 different mergers that are currently, as of today, in the NCUA pending approval status, where they're looking for the member vote to move forward, including several that are within the state of Massachusetts. So, sorry. So we thought that this topic would be of interest to participants, and overall, just a refresher on some of the accounting considerations. So when a merger or business combination is going to occur, the day one steps, really first step is that a valuation of the business, or what's referred to as its enterprise value, or the amount of equity within the organization, needs to be determined. And that's typically done through a valuation specialist with assessment of market or income factors. A couple different ways that a valuation specialist can determine that. But once you have that value, the second step within that calculation is to determine all of the assets and liabilities that are being acquired need to be evaluated and accounted for at fair value on day one. So fair value, with the biggest impact for a credit union, is tied to the assets with loans and liabilities with either borrowings or member share accounts, particularly member share account CDs. So what you're looking for in that analysis is, one, from an asset perspective, any credit risk considerations that impact the value of those loans and the ability to collect its full principal and interest. And secondly, any interest factors. So if you have a loan that is off market conditions, whether positive or negative, from a current interest rate environment, you will get a fair value adjustment to bring that loan to a reasonable fair value estimate on day one, at the date of the acquisition occurring. Any loans within the acquisition, there's also a separate assessment to determine if there are any loans that are what's considered purchase credit impaired, which is basically something that is significantly deteriorated in financial condition at the time of the acquisition, and those loans will go through a specific impairment assessment on a regular basis over the life of the loan after being acquired, or those that are non-purchase credit impairment. The non-PCI loans, we'll get into this in day two, but those are separated from your allowance for loan loss calculation. Instead, a separate credit risk will be evaluated and monitored and calculated. Additionally, any intangibles within the organization acquired need to be valued and measured, the most common being a core deposit intangible, although there could be others as well, such as trade names, non-compete agreements possibly, or any other significant factors. But most commonly, it's the CDI. And then once you have all of that valuation information performed, the calculation will then basically determine, is there any goodwill that's acquired within this? And you calculate that by taking the fair value of the assets minus the fair value of the liabilities and the fair value of the equity that was acquired through your enterprise value calculation. And depending on that will result in either negative goodwill, or which will go to the income statement, or positive goodwill, which represents an asset that will be recorded on the balance sheet. Again, mentioned the valuation specialist, common valuation specialists we've seen in industry, RP Financial, and Marcum also does valuations in businesses too. The day two accounting considerations, so the additional disclosures that will go into the notes to the financial statements once a merger has occurred. The calculation I just mentioned on the prior page, that's a disclosure that would stay within the notes to the financials for each year that the accounting of the merger is presented. So as an example, if the merger occurred in 2019 and you had 2-year financial statements, you would carry that disclosure in both 2019 and 2020. The goodwill, there are a couple options for accounting for goodwill, and this has evolved several times and kind of come back full circle by the FASB. Originally going back many years ago in early 2000 phase, you used to amortize goodwill, and there was also a separate method of pooling of interest. The pooling of interest got eliminated through the fair value accounting I just went through on the prior page. But then the FASB early 2010-ish, 12-ish range came out with additional guidance through their private company council that allowed a private company to amortize goodwill over a 10-year period if they elected that policy. If that policy is not elected, then you'd be evaluating for impairment through either a step 0, which is a qualitative analysis that the FASB has spelled out in ASC 842, I'm sorry, 805, that goes through all of the different economic and business conditions to determine if there was an impairment or a need for a further assessment under a quantitative fair value analysis, which is referred to as step 1. Important to note, if you elect the policy on amortizing the goodwill, each acquisition needs to be accounted for in a consistent manner under that policy. The next step as well in day 2 is any of the fair value adjustments that were identified do need to be amortized and recorded into the statement of operations in future periods. So just a simple example, a loan with a carrying value of $10,000 and a fair value was $13,000. So on day 1, you're going to record that loan at 13 as an asset versus its 10 carrying value. So that $3,000 difference will get recorded to interest income over the life of the loan. So in this case, with the fair value being higher, that extra debit will actually negatively impact the yield going forward. Any identified intangible assets also need to be amortized over an estimated useful life that's determined upon acquisition. And then subsequently the accounting for the loans, and you still will evaluate any credit risk. The PCI loans are accounted for under 310-30, while any non-PCI loans would basically follow a general reserving type of model. But they, like I mentioned, they are not part of your allowance for loan loss calculation. It's a separate assessment of credit risk. Important to note, what Ms. Brenda just talked about CECL, the accounting under ASC 310-30 for PCI loans does get amended. So that if you do have an acquisition or had conducted a prior acquisition in the past, that is an extra step of the CECL adoption that you will have to evaluate under a new term called purchase credit deteriorated assets. We listed just a couple pieces of guidance from the NCUA on mergers and acquisitions. They have a detailed Q&A that kind of goes through a variety of steps. I'd say this guidance is more on the process with the NCUA and less about the accounting specifics. But we thought this would be important and relevant in literature for you to consider. Certainly, as I mentioned, the overall accounting for this is under ASC 805 under the FASB codification. And then other factors too to consider. The big four CPA firms all do have business combination guides that go through step by step as well. Those are always helpful tools, and you can download those pretty easily from the internet if you ever needed them. The next topic we had on the agenda here was for lease accounting. This is under ASC 842, which is a new accounting pronouncement that was issued as a result of Accounting Standard Update ASU 2016-2. It's kind of similar to CECL. This one's been out there for many years now, basically since 2016. The adoption period for public companies was several years ago, and actually private companies would have had to adopt this, I believe it was last year, but the FASB did allow for several deferrals. So including most recently, the deferral allows this to be for fiscal years beginning after December 15th, 2021. So that would be your 2022 annual statements. And then quarters would be commencing in subsequent years, so March 31st, 2023 for quarters. So what that would result in is a call report for 3 quarters of the year, not applying the lease accounting standard, but then your 4th quarter call report in 2022, including that. So certainly something companies can consider. Do you want to early adopt as of the beginning of 2022 so that all 4 quarters of the year are consistent call reports? Or are you comfortable with having your 4th quarter a different analysis than your 1st quarter of 2023? The accounting overall, not a significant change for lessors. So we focused our accounting topics and conversations here really around lessees. And the biggest impact is going to be, we'll get into this on the next slide, the fact that you will be recording what's called a right of use asset and a liability for the future minimum lease payments that are under the lease. So basically, think of it as the operating lease would now be looking just like it was a capital lease where you were recording an asset and liability in the past. The adoption, you are allowed to do the adoption on a modified retrospective basis, so you don't have to have comparative financial statements, and any adoption impacts under a modified retrospective basis would go through retained earnings. But typically, we don't see much of an impact, and I'll get into that in a bit here, but really the adoption is purely more of a balance sheet gross up, so there isn't generally expected to be an income statement impact that would have gone back to retained earnings when you adopt. The standard does call for a series of different practical expedients. They do require being adopted as a suite package, several factors. Most companies will want to adopt this, but obviously that's up to your organization to evaluate and assess as part of your accounting policy. The key factors behind the suite of package here with the practical expedient is that you don't have to go back in time and reevaluate your historical leases. to determine, one, does that qualify as a lease under the new lease standard? The new lease standard does slightly modify the definition of what a lease is, so that you don't have to go back and reevaluate that. And then secondly, that means basically if you had operating leases previously, you're going to continue to assume they're operating leases and count for them accordingly that way. And then there's a couple other shortcuts and other factors that just help make the assessment more efficient and effective for you upon adoption. I mentioned the key requirements that you'll have the right of use asset and the lease liability, and there will be some additional disclosures we'll get into. So this slide just kind of summarizes overall the key financial statements and their current accounting versus what their future accounting would look like. So under operating leases, the asset versus the liability. Important to note the calculation of a right of use asset. Basically, you first start with the present value of the future lease payments. And that present value calculation uses a discount rate, and there's some assumptions around the period that is being applied for what the lease represents. Once you have your liability established, the asset is then equal to the liability plus or minus any initial direct costs that were associated with acquiring a lease. And this is something with the practical experience, you don't have to go back and identify any of these costs, but if you had a new lease that was signed subsequent to the adoption of this standard, if you had to have significant legal fees or other costs in entering into that contract, you may be capitalizing those as part of the overall arrangement. If there were any lease incentives, so 3 months of rent or build out assistance, things like that, those are part of that right of use asset calculation as well. And then GAAP does require lease expense to be recognized on a straight line basis over the life of that lease. That hasn't changed under the accounting, so you don't really have an income statement change or impact. But previously under GAAP, the asset or liability that resulted from the difference in straight line compared to a cash basis, that was recorded as other asset or other liability generally. That should now be accounted for and included in the calculation of what your total right of use asset is. So steps to adopting, the timing is coming up quickly on this one. And in conjunction with you'll be adopting CECL and similarly, so a lot of different FASB projects on the horizon at the same time. You should really start by identifying what are the leases that you have in your organization, certainly starting with the basis of items that are currently accounted for as leases is a good, obviously the right starting point. But then secondarily, were there any other contracts of significance that perhaps may have been a lease or may contain a lease that weren't necessarily accounted for as a lease in the past that you should now be considering? So look to things like arrangements with ATM machines. Are those leases? Are they just rental or something that's owned? Are they maintenance type arrangements that really wouldn't be a lease? Any buildings and technology, there's another key area to also focus on if there's any leases within your technology, whether that be LAN systems, servers, or even your core application potentially. But we tend to see core applications are not leases, but again, something you should evaluate in your contract. The key aspect behind, and one of the more tricky parts, is when you have an escalation clause or options to renew within a lease, determining the extent of period of payments that you're going to be using to calculate that lease liability and ultimately the asset is probably the largest question we get from clients on this topic. And it just comes down to, is it really probable in nature that you will extend that lease? So if the lease is, as you're going through the adoption and the lease is up for renewal 10 years out, perhaps you don't have enough crystal ball and foresight to really predict that's probable in nature of being extended. So you would exclude those extensions in your analysis, as compared to perhaps you're 12, 18 months out from that lease renewal, and you have a little more prediction ability. Maybe you would include that renewal since it's a little more short-term and closer and more easily determinable that it's probable to extend. So again, the judgment and facts and circumstances, but one point to look out for within the analysis. I mentioned the practical expedience earlier as you're going through the adoption, and you should be documenting and assessing, will you be applying those practical expedients? And then the discount rate, most commonly for private companies and credit unions, we typically would see the discount rate being the incremental borrowing rate. So looking to some sort of Fed funds rate, FHLB type borrowing rates, those type things of that nature that can, use something that's tied to the duration of the leases. So if your weighted average life of the leases is only 2 years, you wouldn't look to a borrowing rate that's a 20-year type borrowing rate. You'd look to something that's more short term. Depending on the extent of how many leases you identify, also will help determine what types of tools are necessary for the adoption. Is this something that you can manage and maintain within a spreadsheet, or will you need to go hire a specialist to assist you with the calculations analysis, or actually go out and purchase a specific software tool that is designed to help with the accounting? We do have tools that we've worked with our clients on, so you can certainly talk to your CPA about that as well, or talk with Marcum. We're happy to assist companies in the adoption if you're looking for assistance. And then, from a lending perspective, this is not so much on your leases, but more so your loans that you have on the books. If there's any commercial loans, particularly that have covenants associated with them with your customers, you do want to take a look at that, because your customers perhaps will also be adopting this new standard if they're a private company. And if there's covenants that are tied somehow to the balance sheet, this could have an impact now in the future to those covenants, and you may need to amend the covenants as a result of that. This just goes through a lot of the different disclosures. Overall, the largest increase in disclosures, I would say, ties into your discount rate that's being applied. You typically would have had a schedule already in the footnotes of financials that disclose 5 years of future lease payments. But overall, you will be adding in now the discounting factor and how the present value is determined. And if the asset or liability is not presented specifically as its own line item in the balance sheet, then your footnotes should give disclosures as to where that is presented in the balance sheet. The last topic we had was premiums on callable securities. This was actually a standard that was applicable for last year, for fiscal years beginning after December 15th, 2019. So most companies probably have adopted this already, but we just thought we'd give a little bit of a refresher on this. The FASB issued this back in 2017 as a result of diversity in practice, primarily. With premiums on a bond, previously GAAP required those premiums to be amortized out to the maturity date, but a lot of these bonds do end up getting called if they have a call feature. And so upon the call, a large debit would be recorded to interest income for amortizing that excess premium that was being amortized on a longer basis versus should have been on a shorter duration. Now this allows for those premiums to be amortized to that earliest call date, which does help in some of that lumpiness that may have occurred in the income statement. Some companies were applying this, some were not. Again, a cost-benefit decision. That's why there was diversity in practice, and the FASB wanted to bring it all to one consistent model then. I think the biggest point we wanted to make through this was on mortgage-backed securities, as mortgage-backed securities typically do not have a call date. So the premiums, in that case, you're really basing that on prepayment assumptions versus taking that all the way out to a maturity date. So you should still be considering some shorter duration as a result of mortgage-backed securities typically do prepay versus go all the way out through their extended life. Erica, that wraps up what we had as the overall slides. If we want to go into any questions that are in the chat box.
Yeah, we do have a couple of questions, Mark. One that came in is there a standard rate to use for present value of lease payments? What discount rate should be used at this time? Industry standard?
Yeah, as a private companies, you're allowed to use this practical expedient aspect of an incremental borrowing rate. So I think you should look to, if your organization has borrowings, look to what your borrowings and your ability to borrow at that time of adoption. If you could borrow at 2%, you would typically use a 2% discount rate. If you don't have that factor, you can look to other industry borrowing type rates for something that's similar in nature.
Okay, and we did have another question. It's good. This is to earlier in the presentation. Please elaborate on the 3-year phase-in. If we can spread the adjustment for 3 years, what happens when the balance changes and the adjustment does also?
So that 3-year phase-in specifically relates to that day one adjustment. So that day one adjustment amount as calculated, that won't change. That will never change. It's just a matter of it not having to pull that full negative impact on capital in on day one. So that's what that 3-year phase-in relates to.
And the NCUA final rule goes into a little more detail behind how that phase-in works. And basically the assessment was they didn't want to punish the credit unions for potentially having a violation of the minimum capital requirements as a result of the adoption of a new standard. Instead, give the credit union some time to build up the capital if it's needed because of this adoption.
Okay, and that seems to be it for questions. If anyone has any other questions, this would be your opportunity. So feel free to jump in. Let me just check. Yeah, so that concludes today's presentation. Thank you very much, Mark, Brenda, and Dave for putting this together for us and for your time. We're very appreciative. Let me just see, I think. No, we're good. Everyone in attendance today will be emailed a copy of the presentation, and we'll have the recording of the webinar available sometime next week. I'll let you know when that's ready. And in closing, just please mark your calendars for next month's presentation. It's on Wednesday, August 18th. We're going to be having a speaker talk to us about the specific ways highly profitable credit unions calculate the value of diversity, equity, and inclusion. And I'll be sending out the details about that in the next couple of days. Thanks for joining us. Oh, hang on, let me just make sure and check. Yep, everyone's just saying thank you to Marcum. Thanks for a great presentation. Thank you. I agree. Thank you very much for being here with us today.
Great. No, thank you.
Our pleasure. Thank you.
Thanks. Take care. Talk to you soon.
Have a good day, everyone.
Thanks, everyone. Bye.